Hey everyone, hope you're having a good day. My name's Andy. My channel's Finding Value. We're going to be ripping into Twitter, see what people are sharing on social media. I'm going to interject my financial opinions as we go. It's going to be commodity, stock market, wealth building, financial related topics. Sometimes I go off on tangents with TradingView and show you guys a little bit more data that's backing behind all this. I do selectively choose a lot of these posts, repost them, try to get them in a close order where it's information that ties together, tie it all together. So let's go through here, give you my financial opinions. We've got at finding underscore finance. And then we've got finding-value.com. If you guys want to join our community, it's not just community. I also teach, educate, train investors to become better investors. The best part about it is you manage your own money, and I can give you the tools to help you figure out how you want to navigate the markets. I can't give advice or anything like that, but I can educate you on the stuff that I know about the markets. So, looking at Nick here, he goes, White House ready to lift sanctions on Venezuela so the oppressive regime can pump more oil. This admin won't allow pipelines to be built and oil to be produced here by U.S. workers, but removes sanctions and helps totalitarian states produce more oil there. And it says follow for more. The one thing that I'll say, and I'm not trying to make this political by any means, is when there's a problem in oil, they're going to go around and they're going to try to pump more from wherever. That's what they're going to do. The pressure is going to build in the financial markets with inflation. And then the pressure is going to build on the supply side of oil. And they need oil to not translate the credit or the dollars in the system to move into the consumer price index. Oil is that translator of inflation. So they're going to do everything they can to prevent that translation of credit and money into the consumer price index. What I expect out in the future, if prices get high enough, and I think they will, they are going to open up the world to produce as much oil as it can. That is where the energy service sector and companies are going to do absolutely insane stuff. And the exploration production companies, they're going to do well because the prices are going to be high. So it's going to be a win-win for everyone in the energy service and exploration production area, in my opinion. Here is signs that China is coming back, not expected in the oil markets, coming to oil prices. And it's overnight data shows that China manufacturing activity expands for the first time since March. There's a couple of things that I've gone over that are indications that China may be increasing production. I would ask everybody, what do you think those things are? Well, iron ore is broken to the upside, steel's firming up, the Baltic Dry Index is moving up. Those were all indications before the news came out that China's manufacturing is going to be expanding and that it expanded for the first time since March. So people are already positioning in those sectors based off of this information that was already known to those that are the insiders, the people who are in the know and get the information first. Then this comes out later, so all of us get to read it, and then we start to make decisions on how to invest. But if you're looking at the charts, we can see that type of breakout. So let's take a look real quick. I'll show you what that looks like, guys. So here is iron ore over in China. This is iron ore, China, 92% iron ore, or 62%, sorry. You had a big move up. This is your consolidation pullback in this falling wedge. You can see the three humps there. And we've broken this to the upside. That is signaling that manufacturing is probably going to move higher from this point on. I also know they've done stimulus over there. Stimulus at the bottom of a real estate market bust is going to be good for a recovery phase. And generally what does real well in that recovery phase is technology companies over in China. Now, that's how the cycle works in America. I'm pretty sure that's how it's going to work over in China. But things do look a little bit better, and they are coming back up. Another thing is Baltic Dry Index. Baltic Dry Index is another index that is indicating that we've had a falling wedge, a breakout to the upside, and it's starting to move higher. So iron ore, the Baltic Dry Index, and these breakouts of these charts that I'm showing you, they're all interconnected to the news that comes out later that there's signs of China's coming back, not expected in the oil markets. If you've been paying attention to the daily updates, we already are in it and positioned for that move that is coming in these sectors. There's also sectors that are still down that I think are going to start to turn up that are lagging a little bit behind it. You can also look at aluminum. We've been looking at aluminum. This is a crazy looking chart. Look at the move off the bottom of aluminum. There we go. Look at that move. We know what to do, guys. If you're part of the website, you know what companies I like. Check out the midweek updates and all that, and check out aluminum company that I like. There it is. There's that big move up. Do you think that's at all interconnected with signs that China's coming back, not expected in the oil markets and all that? No, the oil market's already pricing all this in. But aluminum, steel, iron ore, Baltic Dry Index, guys, it's all interconnected. All this stuff's interconnected. Now, I know people are worried about the recession and the inverted yield curve and the likelihood of recessions coming after the inverted yield curve. This is your inverted yield curve. I know people are really worried about it. The invert here, I'll flip it this way. The inversion's down here, and that's when the yield curve uninverts. This is the inversion of it. But we haven't started to uninvert yet. It started to uninvert in March of 2020. That was your breakout, and that was when we had the problem. But that was also kind of a man-made shutdown, all that stuff. We're back to an inversion again. And that inversion down here, it is starting to slightly come back up. The one thing that is very weird and is a disconnect in the market is that gold is not moving higher with this move up. It's actually broken down. Now, I don't know if this is a real breakdown. I would be looking for a potential slingshot to the upside if we get yields to fall. But we've got some weird setup here where manufacturing strengthening in China. We've got breakouts to the upside of iron ore, aluminum, and all these different things. Gold's decided to take a detour lower. Now, does that mean that the yield curve is going to invert further, where we stay inverted? Maybe, but it sure doesn't look like it. We've got a break to the upside here where the yield curve's moving on up, but it's done that on a bear steepener. What is a bear steepener? A bear steepener is when the long end of the curve goes up more than the short end of the curve that hasn't moved. That's what's called a bear steepener, and that's generally inflation getting priced out on the long end of the curve. And that happens more towards the end of a late cycle. It can happen more towards the end of a late cycle. And late cycle means that we could slow down at some point in the future. So we've got all this information here, and I know I've got some more information over on Twitter to help us try to figure this out. So, and I'm going to switch between a bunch of different information. It says, I'm looking for 2% rebound in uranium Monday to start October in the fourth quarter on the back of 11th hour deal in Washington and a red Friday. Markets should settle down now with the US dollar and treasuries. I think we're in great shape going into seasonality. This is seasonality. I don't put any sort of weighting on seasonality. I really don't care about seasonality. The markets are going to do what the markets are going to do. And we did get a bearish engulfing on Friday where we could see some downside pressure. The bearish engulfing, we can just yank up URA. It's in all of it. This is what a bearish engulfing is. That generally is a short-term topping pattern that goes down. Now, I know uranium's really moving to the upside. There's no way I would try to time this. This could come down and reverse so quickly. It could do it in a day even. So again, this is a reversal candlestick. It could pull back. But as you go and we further into this uranium bull market and the bull market in commodities in general, you're going to have shorter pullbacks and they're going to be not as long. So what I'm going to do is I'm not going to do anything. I'm going to ride this sucker higher. And I'm not going to try to time the short-term market movement. So people are going to say, oh, it's a short-term top. It could be a short-term top. We could come back. We could go sideways for a while. That's all possible. But I'm just not going to risk being out of something where the momentum is so strong to the upside. So keep that in mind as well. And let's keep diving in here. Bank of America, we could be in trouble here. Remember the yield curve being inverted. Remember that we've had a strong move in yields to the upside. That is causing havoc in the banking sector. And we've got Bank of America, we've got, this is the last previous crash that we had. The previous crash was from bad loans, bad credit, bad loaning in the system. That loans destroyed Bank of America. It was a bad move lower. Now, I know a lot of people think that they're going to expect a huge crash, but you may not have a crash, and the speed of the movement may not be the same. We could go down, we could contract on Bank of America. There could be bad bonds that they hold, because I know they have a lot of bonds that they have losses on. There could be other things that are going on in the system, like bankruptcies, foreclosures. I don't think it's really foreclosures from residential real estate, but there could be foreclosures in commercial real estate. There could be bankruptcies in small businesses or whatever it is. There could be some things in the system that need to get flushed out. And this here is a early warning sign that there could be something bad in the system. Bank of America is breaking this rising wedge to the downside. So there could be some rough riding coming up. And if that yield curve starts to uninvert, that one that I was talking about, what this is telling us, and what we generally see in history, is the yield curve starts to uninvert. So here's the last uninversion. So we stay inverted for a long time, and then it came and we moved on up. That was kind of a man-made shutdown thing. So it's kind of a rough one there. But let's go to the one before it. And I can turn on the line here. This is the last one. And you can see we got this bull shape. This is more of a natural tendency. We came on up and we had a recession and a crash as this was coming up in 2008. It was right, you see here. Yeah, it was right in like this. No. Right in this section over here. I think it was late 08. It was like over here that we had a crash. It was like September, October, November, somewhere in that range, 08, 09. It occurred as the yield curve was uninverting. And that's what I'm looking for. We're pinned down here at a very low level, and it's staying pinned at the moment. So we're down, we're real low, but it does look like we could be breaking a trend line here, and we could start trending higher. If we start trending higher, and on top of it, we start to see the rollover of a lot of these different banks, a lot of these different NASDAQ companies, we could see a slowdown in the market. And it is high. The likelihood of this slowdown increases as we tie all of this information together. So we could see a slowdown coming up at some point. It is possible. Coming on down, looking at Grady. Uranium miners did 500% in its baby bull move. We've got a long way to go. URA is breaking out against the S&P 500, a big time against the S&P 500. It says, I said 3.5 years ago, the commodities bull market will be the opportunity to get out of the rat race. What's happening here is we've got a RSI breakout. You can see it consolidated here. And that's the same consolidation with the price movement, but we're breaking to the upside here. And we could see a violent move to the upside where the S&P 500 goes down at the same time that URA and uranium and all these other equities go up. We could see at some point, as the equity markets go down, depending on the forcefulness of the equity markets going down, if they do go down, we could see a grab lower on some of our equities for a period of time. So you have to ride through it. It's going to be a little bit more volatile if that were to occur. If we were to look at the S&P 500 as I kind of go back and forth here, this is the real-time chart on the S&P 500 candlestick. So we had a nice, good bullish engulfing on this day here. But Friday, really weird day. We had a kind of reversal day. And that is a reversal where this could still head lower. It's called a bearish piercing pattern. So really what we did is we reversed, I'll show you on the short term here. So we reversed the downtrend line. There's the reversal on the downtrend line. Then on the uptrend line, we reversed the uptrend line, which could be a flag pattern, which is a continuation pattern to the downside. So we created a flag pattern in a heartbeat, and we could potentially head lower on the S&P, and that could have a profound impact on other assets. As people sell those assets, it can drag some stuff lower. So what I'm talking about is multiple time frames, okay? Multiple time frames. I can be bearish in the short term because the S&P 500 could fall a little bit lower, and that is a possibility. But I don't play the short term. I play the long-term big picture move here, and that's the big picture move. The big picture move is we are going to a land far, far, far away from where we are today in terms of pricing to the upside. It's not going to be an easy ride. It's going to get volatile, and we could be doing it when the S&P 500 is spitting in our face, trying to go lower at the same time that we're trying to go up. And this could, depending on the size of the moves, have an impact on uranium. I'm not saying it necessarily will. I'm saying it potentially could. Two different words there, and I'm carefully selecting my words as I say that. So this does look like we could go lower. Bank of America does look like crap, and uranium looks pretty dang good. Same with oil at the moment. I've got TTF, Dutch natural gas, looks to be strengthening here. You see how this is just putting in higher lows here, and it's how it's just kind of working its way on up? That looks pretty bullish. That looks pretty bullish. I've seen this a lot. What happens is it kind of just turns up and it starts to just continue to go higher, and then we get into that acceleration of momentum. This is what the beginning of that acceleration of momentum looks like. It could still take some time, and it highly depends on the weather. Copper squeezing up, same consolidation pattern as before. What do you mean, same consolidation? One hump, two hump, three humps. One hump, two hump, three hump, and which way are we going to break? This is really important because copper, we call it Dr. Copper. Dr. Copper is a function of the economy. And we have low inventory in copper. I do think this has a high probability of breaking to the upside, but it hasn't broken out yet. Copper is also a validation of the economy saying we're strong or we're not. And we have conflicting information. How is it conflicting? Well, China and their manufacturing is strengthening. We saw that. Iron ore is breaking to the upside. Baltic Dry Index looks good. Copper is probably going to break to the upside. That's my guess, but it's a guess. Now, what if America is weak? Our economy is weak. Well, it could break to the downside. We have an inverted yield curve that I showed you up here. Remember that inverted yield curve? That could be uninverted. That's what's breaking to the upside here. And that's generally when a slowdown or a crash or something like that could happen. So we've got all of these conflicting pieces of data coming out right now. And I'll be honest, guys, I don't know which way this is going to go in the short term. What I can say is commodities look fantastic to move to the upside. And that's what I'm going to bet on. And that's what I'm going to stay doing. But on a shorter time frame, we could see a slowdown. It's possible. It is possible. We talked about aluminum already. That looks really good. We've got total real estate loans. I said they look pretty vertical here. A lot of the times, things are driven by loaning in the system. That is the inflationary driver. So if you look at the loans in the system, they're continuing to go up, and you can see the slowdown. The slowdown occurred in 2008 and 2009. You can see the real estate loans crashing, coming back down. That was the destruction and deleveraging of the real estate market and its impact on all commercial banks and the real estate loans. That is deflationary or disinflationary. As we recover, you can see we recover and we start to cut back on higher. As we go on up, we are still moving to the upside. Are we going to roll over here? I don't know. And we're in the middle of an expansionary phase of real estate, but I think that interest rates are at a level where the affordability is impacting the real estate market. This has not happened in history the same way. A lot of the times, the real estate market's the driver of the inflation, and it's kind of the pace setter. And eventually, I think that the pace setter will roll over, and then everything else reacts to it. To me, it seems like there's another factor that is impacting and overlaid on this market. A bigger cycle is upon us. And I think it's the credit debt cycle that's layered on top of the real estate cycle. So the real estate cycle is strong, but I think the debt cycle and how much debt they need to release in terms of America is pushing interest rates to an unsustainable level, perhaps. Maybe not. But these are all pushing inflation. The real estate loans and the interest rates going up and the expenses on those interest rates. This is me just playing around. GDP is the money supply times the money velocity. I don't think a lot of people know that. Here's the two graphs, overlaid on each other. You can barely tell there's a difference. There's two graphs that are overlaid. They're the same thing. Money supply times money velocity slowing down. You can see it's slowing down, and that's your GDP slowing down. So that could be, and I had to post this just to make sure everybody understood what that means. Slowing down a little bit, and that could mean that we're getting a slowdown. Very much possible. I know that the M2 money supply is slowed down and our velocity is kicked up. So this could have an impact. Very possible. Robert says, data centers already use a ton of juice. The new load from AI will add even further demand. Local grids aren't ready. So what's going on with AI chips? New AI chips use an insane amount of electricity. A single NVIDIA GPU chip consumes about the same amount of energy as a typical US home. NVIDIA GPUs alone will consume more than the entire planned US data center capacity expansions over the next decade. So we've got a gigantic amount of demand for electricity coming from these AI chips. What do you think that means for nuclear and for baseload power? Yeah, we're going to need more. We need a lot more. Here's uranium, decades of production deficits ahead from William Middlecoop. This is the big deficit out in the future. I know some people were shooting around, Kazatomprom is going to increase production by 10 or 15 million pounds per year or whatever. And it's like, guys, the deficits out in the future are just massive. 10 million pounds is like here where my pointer's at. It's nothing compared to the problem that we get out in late 2020s. But you got to remember, guys, the markets are forward looking. Because there's a deficit out here means that people are going to start to contract in the middle of 2020s. So it's going to get interesting. That's all I'm going to say. And we've got this big deficit here. And we've got all this demand for electricity coming online. We've got electric vehicles ramping. We've got AI chips ramping. We've got all this stuff that is shifting towards an electricity world around the world. And what do you think the manufacturing is going to do? We're going to need more steel, more iron ore, more aluminum to support all of this expansion of electricity, the entire grid, and all the cars and all of those things that are coming up. I'm going to skip that one. Jim says, when will the Fed start cutting rates? Okay, this is another indication of when a recession could potentially come, is when the Fed starts to cut rates. It says this chart is derived from market pricing. The first cut is currently priced for August of 2024 in the top panel. Here's August. So we've been going on up. in terms of month of the first cut. And the market is expecting the first cut to be August of 24, 337 days away from the bottom panel. And that's what the market expectations are. Now, read his second post here. It says, notice the first cut is always about 10 to 12 months away. It never gets any closer. Restated, it is August 2024 as today, but the market is never right about this. Let the parlor game continue. What we don't know is we don't know when the Fed's going to cut. We don't know the strength necessarily and the weakness in the market. We don't have that insider information. That also ties with this yield curve uninverting. That's the yield curve uninverting will be tied with potential Fed cuts. And the yield curve uninverting would mean that gold and silver would go up because that's when they perform. But we're not seeing gold and silver perform. We're seeing it break to the downside for a little while. So are we early on this mix? And we potentially could be. We could still be inverted for a little while longer. And right now, the market's expecting that a Fed cut won't happen for another year away. And they're usually wrong. And that cut hasn't been coming below the threshold of 10 months, which means they keep pushing the cut out. Get what I'm saying, guys? We might be further away from a recession than what most people think. This is the bullish percent gold miners at extreme lows with only 10% of the miners in an uptrend. Price of gold's daily CCI readings at minus 200, also a good place for a bottom in terms of sentiment. So we're really low on gold. Gold generally starts creeping up when that yield curve starts to creep up a little bit. And we are creeping up in the yield curve. So it's coming, yield curve could be uninverting is what I'm saying. So this could be a good one to look at. Potential gold miners or silver miners, because it's just it's in the gutter, guys. It's in the dirt. Cheap. And that's where I'm going to end it, guys. So that's what I've got for today. Hopefully you guys, gained a lot of information here. I'm trying to connect all this information together. The news, the charts, connecting it all together so you guys kind of see it yourself. The problem that I have sometimes is I look at charting and I can just piece this all together in like a second. It's like chart, aluminum, iron ore, China's most likely, coming back up. We're probably not going to have a crash yet. That's what I think, but I may not, say that to all you guys and show you the all interconnectedness of this entire market. I look at it as one big puzzle, and you get all this information from charting, and you're trying to connect all the dots and all the pieces of information together to form a picture, or to put the puzzle together to form that picture that the puzzle creates. So that's what I'm doing, and I'm trying to refine my approach on YouTube so you guys can follow along of how I basically follow the markets. So I'm going to be doing this more often in the future so you guys can connect all those dots. I do this a lot on the website as well, where I connect all the dots for people. I let you guys know why I'm buying a company, why I think it's good. There's fractals that I look at. They're repeating patterns over time. The size of those fractals oftentimes determine the size of the move in the future. We also play all the tricks. Where are the cost curves? Are we below the cost curves? We've got the leaders in a sector. We've got potential laggards in the sector, and then you've got your explorers that are lagging even the developers, so to speak. So you got producers, developers, and then the lagging explorers. Use that to your advantage. If the sector and the leaders are starting to pull away, look at the developers. Developers break out. Look at the explorers. I'm giving you guys hints, uranium, where you could be looking at some of the explorers right now, and you could be getting a good deal if you want to go in and up the risk in your portfolio. And now would be a good time to up the risk. All I'm going to say. But yeah, if you guys need any help, check out the website. You can use discount in the coupon code, which is our normal discount. The September discount is over because it is October. We do have a question and answer session coming up next Sunday at 5 p.m. If you guys remember. And we're going to be getting a lot more interviews coming up. I'm going to start lining those up, and you guys can listen to other people talk about the market conditions that we're sharing here. And strategies, different sectors, all that stuff. I'm going to get you a bunch of stuff in front of you. All right, guys. We'll catch you guys later. See you next time.